Welcome back to Accounting Matters, the podcast where we break down the world of financial reporting, what's changing, what's staying the same, and what you need to know. I'm Nicole Harger, a Senior Managing Director here at Embark. And as always, I'm joined by my co-host today, Adam Olsen, Embark's Head of Quality.
How's it
Welcome
going?
back.
Well, thanks.
It's going good. It's summer, you know?
It is. And back to more accounting talk. Here we go.
Okay. So today we're focusing on a topic that's relevant across industries. So from biotech to big tech, accounting for research and development costs.
Yeah. So like you said, across multiple industries, I feel like we have a lot more of our clients asking questions in this space and different projects our teams are seeing. So whether you're running clinical trials, developing software, or optimizing manufacturing, really how you account for those research and development costs can significantly impact your financial statements. And it's also kind of growing a lot of attention with standard setters. So we'll talk a bit about how the FASB is thinking about potential changes in this space. But just a quick rundown of what we'll cover in this episode. So obviously cover the basics like we tend to do here. So how US GAAP really currently treats R&D costs. We'll also touch a little bit on the IFRS side within there. We'll talk a bit about which types of costs can be capitalized, where those opportunities exist, practical challenges that companies are facing, especially in the life sciences spaces, since this is so prevalent there. Mm-hmm. And then again, like I said, just a few minutes ago, talk about areas where the FASB is potentially exploring, maybe making some changes here.
All right, let's dive in.
Sure.
So let's first kind of lay the foundation. What exactly qualifies as research and development under US GAAP? And then where does ASC 730 kind of draw the line?
Yeah, so great place to start. So under ASC 730, R&D includes activities that are aimed at discovering new knowledge or applying that knowledge to create or significantly improve, a product. It could be a service. It could be a process within a company or any techniques they're applying. So, you could think laboratory research, conceptual design work as examples, testing out new formulations, building prototypes, plants, things of that nature. Anything that kind of happens before a product becomes commercially viable can really be inclusive of kind of those R&D activities. Some helpful examples to help illustrate even further. So if you think about like a pharmaceutical company conducting early stage clinical trials for a potential cancer drug, those trial costs would generally be expensed as R&D under 730 since that product isn't yet commercially viable. And then similarly in another industry, take semiconductors, for example. So, a company that's maybe developing a new chip architecture to improve their performance, they would likely be engaged in R&D activities. Once that design is finalized, though, however, and that, that chip in that example moves to production, then those costs tend to fall outside of the scope of 730 and you would apply other gaps. So whether it's an inventory cost to guidance or, kind of property, plant, and equipment guidance that you have in through ASC 360, you'd apply just other applicable GAAP. So the standard is pretty clear, though, I think, on kind of what's not considered R&D as well. So some common things people ask about that does not qualify as R&D is around like design tweaks or, kind of quality control during production, the costs associated with that, activities to help troubleshoot during manufacturing. Those things don't tend to qualify. So even if those efforts feel innovative in a way, and you're like, I feel like we're creating value here, like adapting or changing an existing product to meet a specific customer need, they're not really included as part of that commercial activity, so they can't qualify as R&D costs.
Yeah, and that's a critical distinction, right? So just because something feels experimental or new to the business, that doesn't necessarily make it R&D for accounting purposes. And there's a real focus on the purpose of the activity itself. So for example, developing a new tool that supports R&D could be included, but routine tool design would not be.
Yeah, exactly. And one more nuance. So if a company is conducting the work under a contract where the customer bears the risk of kind of that R&D activity, those costs are usually treated, differently. So kind of think about it as a service arrangement instead of traditional R&D. So, long story short here, I think you really have to look at both the nature of the activity of what you're doing and then ultimately which party kind of carries the risk of success or failure of those activities.
Yeah. So I guess in short, ASC 730 kind of draws a pretty bright line between innovation that's still being tested and therefore expensed, and then work that's actually tied to production scaling or customization, which typically falls under different accounting guidance. So you did mention that most R&D costs are expensed, but there are some exceptions. Can you walk us through what those are and where companies need to apply judgment?
Yeah, so there's guidance within 730 that provides kind of one of the biggest exceptions, and that's when a cost relates to an asset that has, and they use this terminology, an alternative future use. So kind of in plain terms, what does that mean? This means that the asset is not just being used for a single R&D project, but it really has value beyond that. So to help illustrate, for example, let's say you have a company that buys a specialized piece of lab equipment. If that equipment will be useful in commercial production after the R&D phase, it may be capitalized and depreciated over time rather than expensed immediately. On the contrary, if that same piece of equipment is custom built, it will only be used for a single project or single purpose with really no real use afterwards, then it's going to be expensed like other R&D costs. And so this is really where judgment becomes key, and management really has to kind of use their professional judgment to really evaluate what is the likelihood and really the practicality of future use. And it really has to be kind of embedded in real plans for that asset. It can't just be like theoretical like possibilities, but what's actually like feasible for the company in and of itself. And so again, it's an area where if you are going to kind of make the assertion that there's an alternative future use, you have to be able to support that. Your auditors will likely ask questions about it if those costs are materials. So you really have to be able to, illustrate that you've kind of met the criteria of that alternative future use. Other examples that require judgment as well, where there could be exceptions, those include like software development costs, materials, and even facilities. So any of those might be capitalized as well, but only again if there's a clear documentation showing that there's kind of a broader purpose for those assets as well. And then I will add, the FASB, we talked about this on a previous podcast here, is expected to release a new ASU that's for kind of the accounting and disclosure of software costs. So we won't be diving into that today, but just, if you're thinking about kind of research and development as it relates to kind of software costs, pay attention as the FASB kind of works towards finalizing that standard in the coming weeks.
That's a great call out. So I guess overall, it's less about the nature of the asset and more about its future.
Yeah.
If you can make the case that it has a life beyond R&D, there's a path to capitalization. So otherwise, default is still expensing.
Yeah, that's
right?
exactly right. So it all comes down to the use and benefit beyond the scope of a single project. And if you're unsure, probably answering the question yourself, if you really can't draw the distinction, that you're probably in the space where you need to expense those costs.
Yep. Okay, so before we move on, what about the international angle here? Do companies following IFRS handle R&D costs the same way as those under US GAAP?
Yeah, so good question. It's actually kind of one of the areas that there are differences between US GAAP and IFRS. So both frameworks do require that research costs to be expensed, like we've talked about. So there's no questions there. But development costs, where, like we just said in US GAAP, you have to expense those as well. That's where there is a split between IFRS and US GAAP. So like I said, there's a few exceptions in US GAAP where you might be able to kind of wiggle around that like we just talked about, but it's a very narrow area to kind of wiggle out of.
Okay, so what about IFRS?
Yeah, so IFRS takes a more nuanced approach. So under IAS 38, development costs must be capitalized if a company can check a pretty specific set of boxes. So there's a lot of criteria outlined. So you're thinking things like technical feasibility, kind of the intent and ability to complete the asset, that there's a clear path to the economic benefits of that asset, and there's obviously the ability to measure those costs reliably. Those are just some of the criteria that you would have to meet. So they do set a fairly high bar. Like I said, you kind of got to check all those boxes there. But if you do meet those criteria, then again, you don't expense that. You would actually capitalize it and create an asset.
Okay, so if you're under IFRS and you are developing a new product, you might actually have kind of smoother earnings over time.
Correct. Yeah. So because instead of taking, that big expense hit all at once, like you would under US GAAP, you're spreading those costs over the useful life of that asset, which means then for IFRS companies, especially those in kind of high R&D industries like biotech or software, you tend to show higher profitability in the short term just because of how that accounting would work.
Yeah. And that's actually, there's a pretty big difference there, right? Especially if you're trying to benchmark across companies globally.
Sure. Yeah. And it's something that, investors and analysts, they need to be aware of as well. It's something that they're looking through and probably making adjustments for when they're comparing companies cross borders. It's also matters when it comes to valuation work, M&As and deals. Again, it's just like you got to make sure that you understand that if you're looking at maybe a US GAAP-based company versus an IFRS-based company, like you don't necessarily have apples to apples in comparison.
Okay. So let's apply some of this to the life sciences industry. This is a space that you kind of mentioned where R&D spending can be very significant, especially with long-term development timelines and regulatory hurdles.
Sure.
What makes the accounting particularly challenging here?
Yeah. Life sciences is definitely one of the more complex industries when it comes to R&D accounting, just like, again, based on the nature of the activities that they have to do. But one of the major issues that tends to come up is around kind of the accounting for the pre-launch inventory. So this is when a company starts manufacturing a drug, for example, before it receives that regulatory approval. So typically from the FDA for US-based companies or companies trying to market a drug in the US, if approval is considered probable and the drug will be commercially sold, then some of those production costs might be capitalized as inventory under inventory guidance. But if approval is still uncertain, or if the outcomes of the trials are, we're not 100% clear what's going to happen with these trials themselves, then those costs are still going to be considered part of research and development costs, and they will be expense. Another challenge that we see in kind of the life sciences space is around milestone payments in collaboration or licensing arrangements. So in these circumstances, companies often agree to pay a partner when certain development or regulatory milestones are hit. So if the milestone is contingent on future events, so again, say, maybe a drug reaching a certain phase of clinical trials or getting that regulatory approval like we talked about, then that payment is typically expensed when it becomes probable. But if the milestone relates to acquiring a right that has an immediate value or use, then you might see in those circumstances that you could capitalize those. This applies, the same to in-licensed intellectual property. So if the license gives the company a right to use a compound that still requires significant development and there's no alternative use, then the upfront fee for that is generally expensed. But if the license is transferable or can be used across maybe multiple projects that company is looking at, then there could be an argument that you could, possibly capitalize some of those costs.
So even within one industry like biotech or pharma, the accounting treatment really varies based on deal structure, timing, and risk.
Yeah.
So it sounds like you need to have tight coordination between your finance, legal, and the R&D teams just to kind of make sure everybody's keeping everything straight.
Yeah, absolutely. There's rarely black and white decisions that I feel like that these companies have to tackle. So again, each arrangement, you really got to think about the facts and circumstances and evaluate those closely.
Okay. I also want to bring in another layer here, and that's funding arrangements. So a lot of early stage life cycle companies receive external funding to help support development. How does that play in the accounting picture?
Yeah, no, that's a great point to bring up. So funding arrangements, again, add another layer of complexity here. So, when we think about funding arrangements, these can include things like co-development arrangements, structured R&D financing, or milestone-based funding from investors or commercial partners. So one of the most critical questions that, people have to ask and think through is, does the recipient retain the R&D risk, or has it shifted to the funder? That really helps determine the arrangement's accounting and whether it should be accounted for as a liability or as revenue, or sometimes can even be more complex than that. And kind of speaking to that complexity, in certain cases, these contracts may include additional features that require derivative assessment under ASC 815. So, for example, if the arrangement includes like obligations to repay based on future events, they may have embedded options, contingent settlement features, all of those different nuances, can create the need for a company to evaluate whether a derivative has been created, and then again, whether that derivative needs to be bifurcated if it's embedded and separately measured at fair value. So speaking to that derivative kind of situation, we often see this happen in situations where a third party provides upfront cash and then the repayment terms depend on something like regulatory approval, commercialization success of that drug, for example, or potentially future equity issuances. And those terms, they introduce variability that is not clearly and closely related to a debt host. Or in certain circumstances, you may have something that meets the criteria for a freestanding financial instrument. You could then again be looking at having to create a derivative. And obviously there's recurring fair value kind of measurements that come into play, and that creates income statement volatility, all the things that come with derivative accounting. So just something to keep in mind if you are entering into any of those kind of funding arrangements.
So you could not only have a liability or deferred income, but you also have a derivative that, to your point, would have to be remeasured at every reporting period.
Yeah, exactly. And so I think this is just, you think about all the things that a life science, especially an early stage life science company has going on. Probably the least of their priorities or concerns is worrying about some of the accounting outcomes of some of the deal making that they're doing.
Right.
And so oftentimes some of those complexities are missed, and it just surfaces after the fact when probably your auditors come knocking on the door and asking you about certain things and you haven't done it. So, companies definitely need to, I think, be aware that there could be structures in some of those arrangements that do trigger derivative accounting. And just something to keep kind of on the radar if you already have an arrangement like that, to be maybe looking into that, or if you're going to be entering one in the future, and to kind of be on the lookout for that. And then I will say, just from a complexity perspective, some of these arrangements also, they create even more complexity, right? Some of them create joint entities or joint ventures where companies have to evaluate, whether there's consolidation criteria here under the VIE model. Or assess whether kind of the revenue recognition guidance under ASC 606 applies if you have a transaction that's structured as a service. So again, you've just got a lot of different areas of GAAP that could potentially overlap here, that I think it's important that you're, accounting and finance are synced up with kind of legal and operations, and everyone's really understanding kind of the terms and the facts and circumstances of different arrangements that you're entering into.
Yeah, so that really puts a spotlight on how interconnected the business and the accounting actually are in life sciences. The form of a funding arrangement might look simple. We'll give you cash and share in the upside later, but it actually could open the door to numerous areas in the accounting guidance, ASC 730, 815, 606, 810. So the ripple effect there is actually very real.
Yeah, it is. And I think, again, companies don't think through those implications up front. Like we said, we see a lot of companies scrambling on the back end to kind of reverse engineer their accounting for deals that they weren't prepared for, with GAAP in mind on the onset. So again, it's just a space I think companies need to keep on their radar, and again, kind of look at more closely as they kind of enter into those arrangements proactively.
Yeah. So let's pivot into an area that we don't cover much on the podcast. I do think it's important we briefly talk about the tax side of R&D. So even when you figured out the GAAP treatment, the tax rules are creating a new set of challenges. Kind of what's going on there?
Yeah, and there's been a bit of a shift here as well when it relates to the tax treatment of R&D costs. So under revised tax rules, so Section 174 now requires businesses to capitalize and amortize R&D costs over a 5-year period for domestic expenditures, and then it's a 15-year period for kind of foreign activities. And this is a big change on the tax side from kind of the prior treatment where those R&D costs could generally be deducted in full during the year that those costs were incurred. From a GAAP standpoint, again, nothing has changed. Like we've talked about from the onset of this podcast, generally almost all costs under 730 are going to be expensed as incurred. But what this does create is divergence between book and tax. And that inevitably creates deferred tax assets that you got to think through, which then affects your effective tax rates. And again, just adds more complexities to your tax provision and kind of your cash forecasting. So I think for many companies, especially in the life sciences or tech space where R&D spend is pretty significant, like it's a large chunk of where their cash is going. This mismatch is going to be material from a deferred tax asset perspective. And it's going to create timing differences that have to be explained, not just in the tax footnote, but you're probably also going to have a lot of your kind of analysts and investors wanting to understand some of that as well.
Yeah, and I imagine it's not only added complexities, but also some confusion. So not just in terms of reporting, but in understanding the actual impact on cash flows, earnings, and even R&D incentives.
Yeah, it also raises a policy question too. Should GAAP evolve to be more in sync with tax? And that's something I think the FASB is at least starting to explore.
Yeah. So let's turn to disclosures.
Okay.
So right now, companies report total R&D expense on the face of the income statement and maybe give a little color in MD&A, but that's often kind of the extent of it. Are stakeholders asking for more? They
are, especially investors, analysts, and industry-focused users. I think what we're hearing, and again, we talked about how investors in general are just wanting more information, better decision, useful information, more timely information. What we're hearing from them, and I can understand the sentiment, is that the total R&D line isn't telling them a lot about really where that money is going, how far along the projects that the money's being invested in are, what kind of returns those might even generate, some of those investments. And that's a problem, especially where R&D is a significant number on the income statement. And, the investors, they really want to understand R&D by the program, by the product, by the phase. If you've got a life sciences company that's developing potentially multiple drugs and they've got multiple drug candidates, investors really want to know how the company is allocating its R&D across those programs. What phase are they in? Are they preclinical, phase 2? Are we getting near commercialization and regulatory approvals? And other industries have similar needs. Tech companies, we're seeing more and more investing kind of in next generation infrastructure, artificial intelligence, things like that. And investors really want to know how much of that spend is speculative versus what is tied to maybe something that's going to, result in near-term delivery. So again, there's no requirement today to break that cost out any further, add any more granularity. Some companies offer voluntary disclosures and spend more time discussing it, especially if they're kind of a pre-revenue company. They really need to kind of tell that growth story, especially if they want to bring in new investors and kind of get next rounds of financing. They have to be a little bit more clear in the narrative and how they're telling that story, but it's inconsistent still. And I think that's why standard setters are thinking about potentially like enhancing some of the guidance around R&D costs, or at least the FASB's kind of introducing in their invitation to comment, just for companies to maybe comment on whether they think the current guidance needs to be enhanced. And again, it's just to give more context to users of financials.
Yeah, and that makes a lot of sense. Especially in sectors like biotech, where the entire value of the company is kind of wrapped up in R&D, but the financials basically tell the users nothing.
Yep.
So even really a modest improvement in disclosures could help stakeholders better understand the underlying business without kind of a full overhaul of the accounting guidance.
Yep.
So let's talk about, we've hinted this a little bit. Let's talk about what might actually change. So the FASB has added R&D accounting to its research agenda, but not yet the technical agenda. So what's the focus there?
Yeah, right. So we're still in the very early days of this, right? So the FASB, I think, at least has acknowledged that maybe the guidance in 730 is a bit outdated for the reasons we've kind of outlined here. Especially as I think we've seen more and more companies and kind of booming industries invest in kind of that intangible assets of, these proprietary things that they're trying to develop. So I think their goal is really to look at, hey, what is the current, stakeholders, practitioners, auditors, like what feedback do they have on existing guidance? Where do we see problems in that guidance? And like, what are some possible improvements that users would like to see made by the FASB? And I think this could take a few forms. So one possibility that the FASB, I think, could entertain is a limited expansion of how we think about the capitalization guidance. So maybe for development costs that meet specific criteria, again, kind of just aligning with IFRS in a way. So like you've got things that meet technological feasibility or commercial viability, just creating a framework there that I think allows for more opportunities to capitalize some of those costs, I think is one avenue they could take. I think the FASB's challenge is balancing kind of the relevance and reliability of information. So users want better information, which we just talked about, and we can understand why. But I think preparers and auditors want to make sure that there's guidance that's clear and practical and cost effective to apply. Like if there's too much judgment that's required to apply some of this guidance as they go down this path, that I think you just lead to diversity in practice, which creates more issues for just comparability and things like that. So they don't want to overcomplicate a model that's, I would say today is pretty simple, right? So trying to balance that.
Yeah, so we may not see a dramatic change tomorrow, but it does feel like the current model is under pressure, between the tax changes, investor expectations, and growing R&D spend across industries. Seems like there's real momentum to do something.
Yeah. And they may start small, like maybe instead of changing the kind of the recognition or measurement of R&D costs, they may look at things like expanding disclosure requirements, right? So maybe adding more transparency there, especially for kind of later stage development. But, it's kind of hard to say like where they're going to land on some of this stuff. So I do think, if companies have kind of an invested interest, it's something to kind of keep on the radar and watch closely.
Okay. So for companies listening today, what should they be doing now while the rules are still what they are, but could potentially change in the future?
Yeah, great question. I think first and foremost, companies should really understand what qualifies as R&D under GAAP, especially if you're engaging in these activities. Hopefully you've already done some of that and created a policy around it. And I think it may sound simple, but I think in certain industries and certain companies where, you've just got things are moving really fast and you may have spend across different groups and functions, I think there could be a world where costs are just being classified incorrectly and maybe treated incorrectly. So really trying to get your hands around some of that. I think secondarily, companies really should invest in documentation, especially if you're going to be kind of making some of those arguments for capitalization of certain costs like we talked about. So if you think there's an alternative future use to certain assets, or you're concluding that a milestone payment should be expensed, then I think that rationale needs to be supported, and you may better to do it in real time versus trying to reverse engineer some of that stuff when your auditor comes knocking on the door, because they will. So again, stronger documentation just makes like defending your positions a lot easier. Third, you talked about this a bit, and it's just collaborating cross-functionally within your organization. So accounting teams really need to be in sync, I think, with kind of legal, procurement, tax, for example, especially when deals are structured and terms are being negotiated and defined and things like that, just so accounting really understands some of the implications of some of the arrangements that you may be entering into and how that might affect the accounting. Fourth, I'd say monitor, kind of what your peers are doing as well. I think while many companies still provide the bare minimum on R&D disclosures, others, I think especially we've talked about biotech a lot, here they're really setting kind of new expectations and providing a lot more granularity to their investors and users of their financial statements. So whether that's through MD&A or maybe it's even outside the financial statements and it's on earnings calls or in other kind of literature that they're sharing or socializing. So if your competitors are doing that, it may be worthwhile, especially if you're looking for, further funding and investors to kind of come on board, that you're also doing something similar, because that's kind of the expectations of those groups. And then I think lastly here, again, just what we talked about, right? So is there change on the horizon? I don't know, right? It's still, I think, a little early to say what the FASB is going to do here. I think it's at least worthwhile to, like we mentioned, that it is something that's at least on their radar. They've brought it up. They've asked for feedback on it. We don't know where they're going to go with that yet. But again, I think it's worthwhile to stay kind of close to the FASB's agenda. And especially as things kind of move from research to actually creating a project that they're going to be diving into a bit more. That's where I think then, we got to watch it a bit more closely, because that's where the rulemaking changes could occur. And that's, obviously got to be ready to adapt to that as well.
Yeah, that's a really helpful checklist. And I think it reinforces that R&D accounting isn't just a compliance exercise. It's really part of how companies communicate innovation to the market. Getting it right and staying proactive can really make a difference.
Yeah.
So, okay, I think we can wrap up today's episode. Accounting for R&D under U.S. GAAP is still rooted in a more conservative expense as incurred model, but for companies pouring millions or even billions into innovation, that approach can sometimes obscure kind of the full story. So between life sciences, software, and advanced manufacturing, the pressure is really building to modernize how we account for and report on these investments.
Yeah, and while the standard hasn't changed, I think it's clear that we're heading toward a more nuanced model. So whether that's better disclosures that companies are providing, maybe limited capitalization in certain circumstances, or some combination of both of those. In the meantime, I think companies, though, need to be diligent, thoughtful, and above all, clear about how they're applying today's rules when it comes to R&D costs.
Yeah. Well, thank you for walking us through all that today, Adam. For those of you listening, we hope this episode helps you feel more confident in making your decisions around R&D costs.
Yeah. And again, if you're an organization that's navigating the evolving R&D accounting issues, we're always here to help, especially in those funding arrangements where derivatives sneak in. I think that's where people pick up the phone and look for some support there. But we're happy to help you evaluate, current approach, planning for any upcoming changes, implementing new processes, really just supporting you through every step of the journey.
Yep. And if you'd like to continue the conversation, feel free to reach out to us directly or connect with us on LinkedIn. We're always welcome your questions. Thanks for joining us on Accounting Matters. And don't forget to subscribe to stay current on all the latest in financial reporting. We'll catch you next time.